Good afternoon, everybody, and welcome to the last in our 2024 series of Professional Advisors Working Lunches. Today, we're partnering with our good friends at Schroders. I'm Sahar Nazir, News Editor at Professional Advisor, and I'm going to be your host for the next hour. Now, before we get going with today's session, let me quickly run you through the usual housekeeping. So I should inform you that this session is being recorded, and as usual, today's working lunch is going to qualify for 1 hour of CPD, and we will be sending your proof of attendance along with a link to this recording, which will arrive in your inboxes next Monday. So please feel free to share the recording with your colleagues. Now, as we look back on this year, I think we can all agree that 2024 has been one of the most challenging years for financial advisors, at least for the past decade. As if the challenges of consumer duty haven't been sufficient, the industry is currently dealing with an uncertain political landscape, a continued cost of living crisis, UK and US elections, and not to mention the fallout from the budget. Now, as well as the impact of the ongoing conflicts in Ukraine and the Middle East as well. It's at times like these that it serves us well to really take a hard look at our businesses and check that we're running as efficiently as possible and evaluate where the opportunities for growth will lie in the coming year. So with that in mind, what better time to take a look at the results of one of the largest surveys of advisors to be undertaken this year, and to present the survey results and shed some light on where the challenges and opportunities lie for advisors in 2025 are Benchmark's Commercial Director, Gillian Hepburn, Stuart Podmore, who is the Investment Propositions Director at Schroder Investment Solutions, and to take the view from the advisor community, a great friend of Professional Advisor, Unique Financial Planning CEO, Philip Martin. This session is going to give an insight into advisor views on markets, client investment sentiment, consumer duty, wealth transfer, the implementation of artificial intelligence, and sustainability, amongst others. The information in today's presentation is so hot off the press that it hasn't even appeared in the press. So the official press launch of the survey results is actually happening next Monday. So for those of you attending today's session, will be getting a sneak preview. Now, just before I hand over to Gillian, let me quickly run you through our learning objectives for today. That by the end of this session, delegates will be able to understand the changing advice market and the key challenges, explain advisor and client views on the investment market in October and November 2024 and how these have changed and future predictions. And number 3, discuss advisor sentiment on key topics such as consumer duty, wealth transfer, outsourcing investment propositions, and the use of technology such as AI. So that's it from me for the time being. Let's hear from Gillian Hepburn at Benchmark. Afternoon, Gillian.
Afternoon, Sahar, and thank you very much for that introduction. As we've done this previously, what we'll do is we'll take through some of the data from the survey and break and have a chat with Philip, who'll give us an advisor view. So is the survey data aligning what advisors are really thinking? But actually, I absolutely am convinced that it does. You see from this first slide, the survey was completed by 293 advisors, and that is an increase on last year. So I firmly believe that this is a proxy for the advice market. It's always important also to understand the date at which point we did the survey. So the survey was completed between the 23rd of October, the 5th of November. And for those of us who remember back to then, on the 30th of October, we had the budget. So some of these questions when advisors were answering were kind of as we were leading up to the budget, and some were after that. So just to bear that in mind, because it is always very relevant. But to highlight that this is a survey that's completed. Our main survey is done in November, and we do have a little pulse survey that goes out in May. So some of the data you will see will have a track record every 6 months, and some of it will just be annually, and some of it might just be new. So with that little background, just before we kick off, and I will hand over to Stuart in a minute to take us through some of the investment related topics, I just thought it was also interesting to highlight that we are celebrating 15 years of the survey this year. there. So as we've said here, 15 years of insight. And if we cast our minds back to 2009, what was happening at that point in the world? So just a few things to ponder. Barack Obama was sworn in as the president of the US. For the music fans amongst us, Lady Gaga had many weeks at #1 with Poker Face. Interesting. Swine flu was the big topic in terms of health. My goodness, if only we had known at that point what was to happen next. We had the big winter freeze as well in 2009. The plane landed on the Hudson River, saving lots of lives. But importantly, bottom right, we start to think about what was happening in markets at that point. And if we remember 2009, I think for me, there were sort of two key topics that were front of mind in terms of what was happening in the financial press. One was retail distribution review. So we were in the middle of implementing that. If we remember, we first heard about the review in 2006 and it was finally implemented in 2012. So all the headlines at that point were really interesting in terms of, commission coming out of the market. Will that be the death of the advisor market? Absolutely not. But also in terms of the overall market and landscape, we were really coming out of the credit crunch. So it was a very interesting time for those of us who were around 15 years ago. And what we did was we just had a little look back to the survey of 15 years ago to see what were we asking at that point in time. Now, the survey was very different when we ran it 15 years ago. We did ask about this whole move away from initial commission as it was at the time to ongoing or renewal. So there was some interesting data. I'm not going to go to all the stats today, but we did start to see this thinking and this shift away from upfront commission to ongoing, and actually which then translated into fee for service. Top right, in terms of where were people investing, so a kind of clear move to bonds. A clear move away from property. Why was that? Well, if we remember at that point, we'd seen some gating of the property funds, which was to be repeated again post-Brexit vote. But this was the first time we'd seen some challenges in terms of property. And I have to say, I remember at that point in time, I think the previous year or two before that, we'd queued people into property funds and then we queued them back out again. Always interesting. Bottom left, for anybody in the platform market, we asked who will the winners in the platform market be. Top two thing we see there were Co-Funds and Scandia Celestia. Interesting when we think about who are the top players today. And then I love the bottom right question. Those of us might remember the big debate. So the FSA, as it was at the time, had said that advisors shouldn't be able to put all of their business on a single platform. Interestingly, the vast majority of advisors disagreed with that, with 176 advisors of the 196 interviewed saying, yeah, we think we can put all of our business in one platform. So we had a bit of fun with this question because we said, as part of the survey this year, as a starting point, let's wind forward to 2024. We asked advisors, how many platforms are you now using to place new business? And only 18% are saying a single platform. Massive reversal from the survey back in 2009. So that was just a quick look back and an introduction to looking forward. So with that in mind, I'm going to hand over to Stuart Podmore, who's going to take us, first of all, through the market trends that we observed in this survey. Stu, over to you.
Thank you very much, Gillian. Actually, can I, if you'll permit me, I want to look back briefly before I get into the detail. It just struck me while I was listening to Gillian's piece there by way of introduction. When I think back to 2009 when we first launched this. Now, I wasn't working here at Schroders. I've just passed my 9-year anniversary at the firm, but I remember when the FTSE 100 was at something like 3,700, and to think of it comfortably above or thereabouts around 8,200 today is really, with the benefit of hindsight, it's difficult to encourage clients, of course, to take those sort of once in a generation opportunities. But let's just take a look at where we are with trends right now. This particular slide, we always ask this question around asset allocation, and I'm always struck by just how savvy advisors are, and how very much typically advisors, financial planners have their fingers on the pulse of those asset classes that are looking better value and looking more attractive. If we take a look at the last 12 months, alternatives top of the pile here, including real estate and property. What does that tell me? Well, I think that advisors realized in working with their clients that in terms of 2022 and 2023, it was a really challenging time. You saw correlation increase between equity and bonds. So that positive correlation and the losses experienced by both of those asset classes in 2023, for example, when inflation started to bite, saw some clients having really difficult conversations, I would imagine, where we were painfully aware that those holding corporate bonds, for example, and credit had suffered almost double-digit losses. So I can understand why in the last 12 months, allocations and sensible allocations to alternatives have increased. Looks like a very sensible decision on the part of advisors. And it's not just a third bucket for things that don't fit elsewhere. It is a genuine allocation to alternatives. And I'll come back to that later in the presentation today. Emerging markets, likewise, an opportunity there. And developed international equities. And that's where you'll see the US, of course, it appear as well. But then when we switch to the bottom half of this slide and we think about the next 12 months, well, then that gets really interesting. Look at UK equities jumping right to the top of the pile here in the survey. And I can only assume that advisors are very much thinking from a valuation perspective here. Right, UK equities, we know the news flow in 2024 has been very much the story of UK equities being unloved. It's ironic, isn't it, that previously we've talked about the perils of home bias for our clients here in the UK and advised clients, but actually UK equities on an absolute and a relative basis look cheaper than many other different regions and markets, and on that basis could see greater capital flow, according to this survey, in 2024. And some of those earnings pictures, by the way, aside from the valuations, are equally as in reasonable shape when compared to other regions too. Developed international markets moves up into second place, and this, of course, is driven by what I would describe at the moment as the US exceptionalism. When you think about the cyclically adjusted price earnings ratio of major US indices at the moment, S&P 500, for example, this is the Shiller averaged price earnings ratio across a decade. This is upwards of 35 times. It really is a concentrated consensus position because the US has looked so attractive and there's been quite significant flow here. And now I appreciate that when we conducted this survey, the outcome of the US election for our respondents was not known. But clearly there have been opportunities already in developed international equities, and in particular for the US. So we've seen also that the US dollar is at its highest valuation in something like 5 decades. We see US exceptionalism with inflow into debt, in spite of the fact that US treasuries in the 10-year are over 4.2%. So, and what we also see with US exceptionalism, I think, is 70% of the global private assets flow going into US private markets as well. So it'll be one to watch in terms of valuations, but clearly advisors starting to sense that those opportunities exist. And it comes as no surprise that in the next 12 months, given where rates are and given where inflation has been comfortably subdued by comparison to where we were previously, that starts to hit the sweet spot for equities. So I think I can understand that. The final thing I would say at the bottom of the chart is just cash, that actually people are now moving into the market and starting to place their capital at risk once again, having been tempted away by cash, understandably so to a degree in 2023 with deposit-based savings accounts paying upwards of 5%. Okay, so what about market expectations? How do you suspect the following trend to be over the next 5 years? Higher equity market expectations on the left-hand side of this bar chart, higher equity market returns relative to the longer-term historical averages, but that has come down a little bit. So I think advisors are right that, in spite of what I've just said about the attraction of equity, that they suspect returns will be a little lower than longer-term historical averages. There is therefore a commensurate tick up slightly on those who expect slightly lower equity market returns as a result. When it comes to bonds, we have fewer of those respondents actually thinking we're going to see higher bond market returns. But it's got to be said that some of those bonds, particularly US Treasuries, the 10-year gilt, for example, in terms of valuations, looking a little more attractive. And there is a suspicion, a minor suspicion, that there'll be perhaps lower returns there. But where we see a very clear story from advisors and financial planners, I think this is right too, is on the final right-hand side of this chart, the two columns here, that higher market volatility is expected. And that comes as no surprise. That it doesn't surprise me at all. Remember, some people on the survey responded with the full knowledge of the UK budget, for example. Some might not have done so, but none of them knew the outcome of the US election, and they were quite right to expect volatility increasing over the next 5 years. And then in terms of economic expectations, there's a little more optimism here, although higher global growth expected on the left-hand side has ticked down a little bit. Lower expectations of global growth has ticked up slightly in the second column along. But you can see from this chart that I think advisors very much think that the inflation outlook is looking a lot more benign. There are expectations that higher inflation, or the expectations of higher inflation, have come down a little bit, and that the expectations of lower inflation is pretty much level. And you see likewise a significant, on the far right-hand side, expectation that interest rates will start to come down. Now, here's where the jury might be out in that view from advisors. Certainly the consensus view out there is that there is an expectation of falling rates, but I think Schroder's, in terms of our economics team, is non-consensus in as much as we don't expect rates to come down quite as quickly as the market is expecting. So I would just throw that out there for way of a point of interest. Then we asked about sources of disruption, and we talked about following trends. And this is an important one. There's been no real change in advisors' expectations of disruption due to technology. That pretty much is the same, and it has trended a little higher over the last couple of years, so no surprises there. But similarly, I think the sense of disruption as related to the environment and climate change, that's come down a little bit. Let's face it, in terms of action on the environment, we have no choice. We do have to act, but there's a sense that the level of disruption will be a little lower over the next 5 years as clearly we start to move closer to those targets, and one would expect greater action. But on the next chart, sorry, should I say, just before I finish that one, but actually in terms of expectations around the geopolitical risk, then we have seen an increase. And I think I might just pause there. If there's anything that you, Gillian, might want to reflect on at this point before I get into sentiment with
thanks, Stuart. Thanks. I'm very keen to bring Philip into the conversation. Philip, do you want to just very quickly, 15 years ago, how did it feel? Middle of RDR, credit crunch, tough time, yeah.
Yeah, and the move towards fees. Of course, there was massive apprehension in the marketplace about whether advisors' business models could adapt, particularly with the lack of capital in the sector, whether they could adapt and continue to survive. And I think, as you've alluded to in your initial comments, if anything, they've actually expanded. Our numbers have actually grown slightly over the past couple of years. It was big. I mean, I don't think we thought that the impact of that bank collapse in 2008 was still going to be felt 15 years later, but it obviously absolutely is right across the economy.
Yeah, thanks for that. And the whole debate around commission fees is still ongoing as well, I think. I mean, just evolves. Yeah. But if I look back, the headlines were quite interesting, weren't they? Death of the advisor. And I will say that advisors, financial planners, what a resilient bunch of people, to be fair, which is good news, right? Because people need advice.
Yeah, and I mean, I started in this industry 35 years ago, and the average age of an advisor was 57. It still appears to be 57. So we must have been attracting some young people along the way. So there's plenty to be encouraged by. Obviously, the debate's shifting now because it's moving away from do we charge fees to what level of fees and what are we doing for it. So there's a far sharper focus coming from the regulator, and I think that's going to be the singular most important factor, that and the retirement income review over the next 12 months.
Yeah, and we'll come on to some of the data on that. So you've teed me up
Yeah.
nicely for later on, Philip. Just quickly before we move on, views on cash? Are you seeing clients now who are maybe a bit reluctant to invest and we're trying to benefit from the interest rates now starting to move into risk-based assets?
Yeah, well, as a business, we don't take those active investment asset allocation calls anyway. As a business, we're in it for the long term. Obviously, the majority of our clients will hold cash and will hold cash,
Yeah.
even if only for an emergency buffer. We had very few who were trying to take the opportunities when interest rates were between 5 and 6%. So we're not seeing the reversal in the other direction. I think it is one of the really interesting things that needs to start to happen in the platform market. So we need far more integrated cash platform solutions integrating in with mainstream platforms to enable that to happen.
Great, thanks for that. So I'm going to hand back to Stu. Stu, back to you in terms of how clients are feeling about investment.
Thank you very much, Gillian. And I just want to pick up on one of the things that I said about people's expectations for the coming 5 years in terms of disruption. I did touch on the idea of geopolitical disruption. It would come to the audience as no surprise today that our respondents in the survey felt that geopolitical risk was very much still existential. And so it's been proven, actually, just in the last couple of weeks alone, with developments in South Korea, of course, as well as the Middle East. And I think that goes a long way to explaining why this client sentiment chart has changed the way it has. So when we think about this particular chart, if you look at the royal blue bars, they're just representative of those people in the survey feeling a little more bearish versus the navy blue bars are those clients feeling more bullish. And anything in between, that gap in between, is considered to be the neutral position. So you can see quite quickly in terms of the navy blue bars that the bullish sentiment has decreased, both in terms of from the Pulse survey, but also it's fair to say after a significant jump in that Pulse survey is starting to come back down. And I think the geopolitical situation goes a long way to explaining that sentiment, and hence the commensurate uptick at the top of the bars there in the royal blue colours, where you see a slight increase there. But the neutral perspective on client sentiment has stayed pretty constant, actually, between the Pulse survey in May and this survey in November. That's at about 46%. So I guess my take on that is that there's an awful lot of news flow around there that can start to make clients feel, and advisors, of course, feel somewhat worried. So we're just starting to see that reflected here, I think, in the survey. When we delve into client concerns in a little more detail, I mean, these particular concerns, they crop up in every survey that we do. And of course, nobody wants to lose money. So capital loss is right up there. It's actually increased a little bit from the previous surveys that we've done just of late. So capital loss, of course, is always the big one. I get that. I'm intrigued a little bit on inflation. So to the top right, it would appear that many advisors think that inflation has come down a little bit as the number one concern. And it's actually gone up a little bit as the number three concern. So maybe inflation, or the cost of living crisis for advised clients anyway, under these circumstances, has just been mollified a little bit. I find it really interesting at the bottom left here that in terms of generating a sufficient income, that has ticked up a little bit as the number one concern, and likewise the number two concern. So I think it's quite curious there in terms of generating a sufficient income as to why that would be a little more of a concern at this point. Well, time will tell. I actually think that given some of the yields on offer in terms of income, that fixed income after many years after the global financial crisis is finally, of course, delivering what it says on the tin, which is primarily, first and foremost, all about income. And I think to the bottom right of this chart, when it comes to rising interest rates, you can also see a reduction in advisors' concerns here. And I would just, again, reiterate what I said about our perspective here at Schroders, that actually we might easily have a scenario where rates don't come down quite as quickly as people expect going into 2025. We've mentioned cash, and we've talked about cash, both with Philip and Gillian, of course. I thought it was worth just sharing this long-term investing versus cash. So we're asking the question here: if you've got clients who are holding cash and were reluctant to invest over the past couple of years, and now are they more of them investing? And the change here from the Pulse survey in May through to November, you can see that yes has gone up from 49% to 67%. So more clients looking to invest now, and that is perfectly understandable and a good thing for longer term investing, of course. The only thing is that I think for those investing in equity in particular, given what I said about developed international equities and US exceptionalism at the top of my particular section today, just be mindful of valuations. But yeah, longer term investing, winning back some ground against cash for advisors and their clients. And then we did mention that we would touch on sustainability, and in particular the sustainability directive regulations. This is an interesting one. So when we ask the question here about which label do you think will have the broadest appeal to your clients, by far and away the biggest percentage response was not specifically around any of those particular labels, but the don't know category. Here we can see there's been a little bit of a change from May 2024 towards November 2024, but actually that don't know wins out again, and in fact has increased. So I think, look, from our point of view, that as more organizations, I mean, we're now at Schroders, we have adopted 10 labels already for our strategies. So we see this as strategically extremely important for you and your clients, that clarity of labeling, that adoption on our part will continue with gusto actually in 2025, so that we can help to educate and help to bring down that column of don't know and provide some clarity. But there's an opportunity there, I think, to be a little clearer on what we've been talking about thus far. So that's definitely reflected in the survey. And then finally, Gillian, I don't know whether you want to jump in again with Philip just to make some observations on what I've said, or I can just finish off very quickly with private market.
You just finish this one, I think. Yeah.
I'll finish here. Okay. Now, I did talk about alternatives right at the beginning. We've asked the question a couple of times, as you know, about alternatives and about asset classes that advisors think they'll be utilizing a little more. Here's the question: are you considering using private market investment solutions for your clients? That's actually dropped in terms of yes. It's actually gone down for a year ago from 16% to 13%. But I wonder whether advisors are absolutely clear on what their private markets opportunities or options might represent. So in a way, I don't see this as a negative chart. And partly the reason for that is that the launch of the long-term asset fund through the FCA for approval for wealth clients is really significant. So we say here, do you expect some of your clients to invest in an LTAF? And at the moment, the response to that is, as you can see, that there's quite a few people that 50% or thereabouts that were saying don't know. And I think that's going to change. Now, the Bain & Co. strategic paper on private markets suggests that 30% of all assets by 2032 will be invested in private markets. And I think we are set here to start seeing some change. And that don't know part of this pie chart is another opportunity. Certainly what we're seeing at the moment at Schroders is an increase in the number of advised firms in particular that are starting to talk to us about LTAFs. And I think when I think about the numbers of clients or the liquid assets held by advisory clients for many businesses out there, then this will be a suitable and important opportunity for a degree of diversification in order to hit investment objectives. And on that positive note, I shall finish my section. Thank you, Gillian.
Thanks, Stu. Philip, a lot to unpack there. I'm just going to ask a couple of questions before we move on to challenges. One of the things that was interesting for me was the focus on increasing or generating income. We are going to talk a little bit about retirement income review later on, but do you think that's possibly a driver for that increasing?
Yeah, it's definitely one, but also, you know, we, in common with many other advisors in the UK, will have an aging demographic of our client base as well. So they're just naturally moving towards more of a decumulation than an accumulation phase. You know, until that wealth then cascades down a generation, and we hope we'll start a relationship or continue a relationship with the kids and the inheritors of the wealth. So I think it's a combination of things that are going on there. I mean, I personally think it's very encouraging that we're starting to get much more thoughtful and sophisticated about how to generate that income in retirement, rather than just a sort of blanket, let's see how we manage to get four kind of approach. That can only be a good thing and will serve clients better going forward.
Yeah, and I think your point there on the demographic of clients also plays back into that answer about protecting capital being number one priority. Yeah.
Yeah, exactly.
And then the other thing I wanted to ask was the SDR labelling. Interesting, but maybe not surprising in terms of, you know, there's a lot of don't know out there. Do you still think there's a huge opportunity now for education in that space?
There is. It's one of those frustrating things. I always think that, I mean, really, the funds trade body should be grasping this itself and insisting on consistent labelling applying throughout the entire funds industry. And that, you know, I mean, many other occasions where that hasn't happened either. And it would be far easier to do the education if it were built around a common framework.
Yeah, and then finally, any thoughts on the private assets conversation?
Really tricky. I mean, I'm actually astounded by Stuart's stat that he's quoted there from Bain about the proportion of assets that are likely to be in it. I'm guessing actually that might be in UK pension schemes rather than more broadly in held investments. But it's not a topic of conversation that comes up hugely in our business or with our clients at the moment. But it will once the funds start to become better known and better understood as effectively a further asset class to be considering to be part of portfolios.
Yes. Well, the big change there,
of course, has been to be used.
I think the big change there, of course, is that opportunity for wealth clients through a restricted mass market investment to access the long-term asset fund. It's that access point that previously hasn't been available, and now it is, and it'll be really interesting, I think, to be talking about that in the next.
Yeah, you can see too how if it were really joined up, you know, these kinds of assets would be on a government that's driving for growth's agenda as well in order to kickstart the economy. So I think it's a really interesting sector, and I wouldn't be at all surprised if it didn't form a core part of our portfolios going forward.
Yeah, definitely one for us to watch in future surveys. So as somebody who pulls all the questions together, one of the things I always do is keep a track on what needs to be in our radar for the next survey, which will be in May. So conscious of time, let's get on to advisor business challenges, because this is certainly an interesting section. We asked about which factors or what are advisors most concerned about relating to their business. And no surprise that regulation hits the top spot again this year. It is year on year. However, I think the big difference this year is the increase in the number of advisors telling us that regulation was their number one priority and their number one concern. I think what was also interesting was the switch round from the number two spot, which has moved away from finding new clients to actually servicing existing clients. And perhaps this is driven by the regulator's focus on annual client reviews. And actually, what's also interesting for me is the PI cover. And year on year, I've been doing this survey now for 7 years, and it used to be PI was always like the number 2 or 3 spot. And if you look at that, it's way down now. And I think what we're hearing is that, you know, rates are falling rapidly in terms of accessing PI, and it's much more available in the market. So some interesting, perhaps unsurprising in terms of advisor business challenges, and we can come on to talk a little bit about that. In terms of the budget, as I said earlier, this was an interesting one because of the timing of this survey. It was right in the middle of, you know, the budget taking place. But we did ask for those advisors in the lead up to the budget. So we asked them to cast their minds back when they were doing the survey maybe. What specific areas of financial planning did they carry out for clients, or maybe just have discussions about? Interesting, number one was CGT, and that had been long trailed, and obviously there were some CGT changes in the budget. And the second one, again, probably no surprise at this point in time, was tax-free cash, because there was lots of discussions about it pre-budget. Interesting, the one thing that is now causing significant debate is the inclusion now of the pension pot into the estate in terms of inheritance tax planning. So for me, and I'll come on to it, wealth transfer has probably just got a whole lot more interesting. And certainly over the next 2 years, as this is implemented towards 2027, I expect, you know, that to come onto massively come onto the radar. The next one that we asked was, you know, do you feel there's a downward pressure on the advice charge? And again, you know, it's dropped a little bit in terms of the number of advisors that said yes, but nearly 40% of advisors are still saying, yep, there is a bit of a downward pressure on charges. But interestingly, the next slide here, if we look at particularly those middle two columns, despite a pressure on charges, we're actually seeing the charges rising. So those advisors charging between 0.5 and 0.75, that has increased. And those advisors charging between 0.75 and 1, again, that has increased. So bit of a mixed message here. Yes, there's a pressure, but actually in the main, advice charges appear to be on the increase. My favourite topic in terms of you know, wealth transfer, and you know, I talk a lot about this in the broader industry, but again, we ask advisors, are you concerned that as wealth starts to transfer across generations, that you will lose some of those assets? And 62% of advisors said, yeah, we are quite concerned, and that's remained relatively consistent over the last few years. But I guess what we still see is, despite this, maybe the other numbers don't tally and don't paint the same picture, because we see that the you know, the average age of the client bank is staying relatively high. So certainly in that 51 to 64 age group, and also 65 plus. And in terms of the bottom charts here, we ask about changes in the age profile in the last 5 years. And we're seeing that the majority of advisors are still seeing that the age profile of their clients is increasing. It's either increasing or staying the same, but staying the same still means that it's relatively high. And then taking that another stage further, we ask about advisors having a differentiated strategy for two different categories. For younger clients, so younger investors, staying at around the 20% mark, and that's been around that level for many years now. So maybe I need to keep talking about this. But also we ask about the whole strategy on retaining, attracting and advising women, and that stayed quite low again this year. The reason that we ask this, you know, we've done further research at the beginning of this year in terms of this whole transfer of wealth to widows in the baby boomer generation. 34% of those widows told us that they won't stay with a family advisor when they inherit the wealth. So we talk a lot about this in terms of being a challenge for some advice firms if we're not engaging, and maybe an opportunity for others, because these widows are looking for somewhere else to go. So that's a whole different conversation, not for today. I haven't got enough time, but if anybody's interested, always happy to talk about it or share some of our other research. But it is the reason that we hear in the market the statistic that 60% of the wealth in the UK will be in female hands by next year. Now, do you know whether or not that statistic is correct or not? You kind of think, well, you know, we're nearly there, and how do we know? We looked at HMRC data for 2020 to 21. There was about 1.57 billion pounds of estates that moved from across to a single, and 73% of these were women. So the logic applies in that baby boomer generation. Women just live longer. So I thought that was an interesting slide, and maybe we'll start to see some movement in that space. And then lastly, back to that transfer to next generation, and this is a slide I talk about year after year. the minimum asset size for advising clients has, dropped significantly from back in 2019, where 52% of advisors said they were still willing to take on clients with less than £50,000 to invest, and that's now sitting at half of that, only 25% now. And again, does that tie into that whole wealth transfer to next generation? How do we approach that? What do we do? Philip, quite a lot in that section. Any thoughts on that whole piece around, wealth transfer, the whole piece around regulation, and some of the advisor challenges?
Yeah, well, it's massive. You've covered, 3 or 4 huge topics in that section. So I think I always think, when we do this, that 50 grand question is interesting, and we, in common with many other firms, would have a very different approach for somebody that was a relation of somebody who was also a client than if they had come along to us directly with a smaller amount of money, or just starting off. I think this will dovetail and come together, because as the regulator gets more prescriptive about reviews and what need to be included in reviews, you are, I think, going to find that there's a minimum loaded per client cost for the work that needs to be done, irrespective of whether there's any more complex advice. And that is only going to push the required median portfolio level up, not down, because it's getting wider and deeper, isn't it? I think the other interesting stat that I thought that you picked up on there is to do again with the average age of the clients, which I obviously referenced earlier on. But actually, it can often be deeper than that, because your client can still be alive and aging, but provided you're building relationships with those who are going to inherit, you're still making a sensible strategic plan around how you're going to defend the assets in the business. So sometimes it belies just a straight "how old is the client" into the more pertinent question, but do you know the people underneath? Do you, and are you building relationships with the wider family?
Yeah, absolutely. But as you say, loads in that section. So I'm just going to move on now. We've got 3 final sections before we open wider to Q&A. First of all, in terms of outsourcing of the investment solution, I think the big headline for me in this one is, for advisors who outsource, we ask about which of the different types of propositions you're expecting to increase allocation towards. And for me, the big move is towards, interestingly, multi-asset funds. If you look at that bottom right graph, where 35% of advisors said we expect to increase our allocation to multi-asset funds. I think for us, you look back again, we've got the CGT implications of being in a model portfolio, and if it's not held within a tax sheltered environment, what does that look like? And also, in a multi-asset fund, can we offer a broader range of investment solutions? So, ETFs, investment trusts, so potentially a broader range of investments within the fund, and therefore delivering different client outcomes. And thirdly, are we now getting to a point where technology can give us much better look through in a multi-asset fund, so that they can compete in the same way as model portfolios in terms of that client reporting? In terms of reaching a decision to outsource, same as a sort of previous, access to investment expertise comes through spending time with clients, and so there's been marginal shifts here, but I don't think there's anything major in terms of the change in decision making here. I'm going to move on to consumer duty. Wouldn't be an advisor survey without looking at some of this. We've looked at this slide before in terms of the swing that we saw in the whole view from advisors of the impact on their business of consumer duty. So pre-consumer duty, if you look at the bars on the left-hand side, the number of advisors who said, we think that'll have quite a low impact on my business. And then suddenly we saw this huge shift post-implementation. You look at the bars on the right-hand side, where the black dropped, so that was the pre-implementation numbers, and we see this increase. So I think what's demonstrating here is, as we start to go through the implementation of consumer duty, and actually embed it as business as usual, we're still seeing that that's having a significant impact in terms of what we're having to do as advice businesses. The next one, in terms of whether or not advisors think that I'm just trying to read this slide. whether or not the fair value outcome will put pressure on ongoing charges. I think this is an interesting one because it's actually on the model and not actually on the amount that advisors charge. So I think one of the things that will be interesting for us to look at going forward is, will we see the emergence of new models as Consumer Duty, it really starts to get implemented into advisor businesses. And then an interesting one for us is vulnerable clients. We asked this question last year, but we asked it about, how many clients or how many of you have less than 10% of clients being identified as vulnerable. And we split it down this time round just to try and get a better handle on what this looked like. But it still seems relatively low in terms of the number of clients being identified as vulnerable. And I think, we're seeing a huge, a lot of discussion around this from the regulator. It was in their business plan for 24-25. So again, I think this will be one for us to watch going forward, and how do we make sure that we're understanding vulnerability. But it's definitely grown, I would say. And then retirement income review, we did have a bit of a discussion on this, and did the retirement income review, the thematic review, prompt you to consider the retirement, just the proposition? And we've seen, I think, here a significant increase. So a move from 33% of advisors to 65% of advisors focusing on this. And again, we're expecting more on this in the new year. When we asked advisors what were they actually focusing on, well, it was two key areas: assessing capacity for loss and also the investment proposition. So maybe back to our discussion that we had earlier in terms of retirement income. And then the other area we looked at was conversations on annuities. And what we're seeing here is a slight shift up the way in terms of retirement conversations around annuities. Perhaps some of this driven for those who answered post-budget, thinking about that pension pot. How do we manage that going forward? Does it mean that we'll move more towards annuities? And then finally, before we get to further questions, AI, we asked about this. What we're seeing is that still very strong response in terms of advisors seeing this as an opportunity for their business. I think the one statistic or two here that were interesting for me is 21% of advisors telling us that they've already implemented some form of AI within their business. That could simply be the use of ChatGPT. But I think if you look at the right-hand side here, what you're seeing is a real dip in the number of advisors who are now telling us they will never implement AI in their business. So that's a drop, significant drop, I think, from 27% down to only 10%. So certainly a shift in terms of advisors' views on AI. Philip, any thoughts on some of those? I know there was a lot in that section that I covered.
Yeah, well, just a couple of observations. I can't believe how anyone would ever think that they were never going to implement some form of AI. I mean, I guess that probably depends exactly how you phrase the question, whether it sounds like it's all singing, all dancing, because they already are. There'll be a number of things that they're already doing and using that are AI backed. So that surprises me. I personally think, given the nature of quite a lot of repetitive tasks and fact gathering that we have to do in the back office, it's unthinkable that you wouldn't be harnessing this, and probably in quite short order. It'll be an integral part of our business, I'm sure, in the next couple of years. Consumer duty.
I think you're right. Some people probably don't even realise that they might be using it, but it feels to me that the advice process is ripe for AI in a number of ways.
Yeah, well, certainly the delivery of the advice, certainly.
Yes.
I think, absolutely. I mean, even just mechanistic tasks like fact gathering on existing assets before making recommendations and transposing numbers off an externally provided statement into an SR. I mean, it's just self-evidently a straightforward thing that we'd be doing. More broadly on the consumer duty thing, I mean, this is without question consumer duty and and the pressure on reviews, I think, I mentioned earlier, the single most important things that are going to affect our business in the next 12 months in terms of what we're delivering, ensuring it's consistent, ensuring it's documented in the same way. It's just going to have a huge impact right across the sector.
Yeah, thanks, Philip. Sahara, I'm going to hand back to you now for some questions.
Thank you, Gillian. Thank you, Stuart and Philip, as well, for that interesting discussion. We now have just a couple of minutes for a short Q&A. So if you'd like to ask a question to any one of our panelists, please just write it in the chat box. I can actually see a few questions already in the chat function. So let me just go ahead and ask the first one. Somebody has asked about AI. They've asked, how reliable is AI in financial planning above basic uses? They've also said it only works on learned information, which may not always be reliable. So can it truly aid or hinder in a highly regulated environment of an advisor, for example? Whoever wants to go ahead with that one.
I'm happy to take that, Sahar. I think it's a really good question, isn't it? I've often talked in the market about, are we still, for us that remember, are we still at a VHS Betamax moment, right? We're still in very early stages of AI, and reliability has been questioned. So, certainly when advisors are using it, I think there's still that 4 eyes check that needs to be, done, particularly when it's being used for, things like suitability reports. But the other thing we often also talk about is, making sure that you do the due diligence properly on a provider that you're going to use, and actually understanding where the data's going to go, what's happening to the data that's being put into any AI system. Now, I'm a huge supporter of AI. I think it gives us massive opportunities in the industry, but we still got to be careful at this stage and also think about, is this tech genuinely solving a problem that I have? So that would be my take on this.
Yeah, I think too, you've got to recognise that there are various stages in the giving of advice and the servicing of clients. And I think there'll be an awful lot of reticence around AI-generated solutions and advice, but very, very little resistance in drawing together external information, interrogating it and putting it into subsequent reports. 4 eyes checks shouldn't frighten anyone. We do them just now with humans, don't we? So it's an integral part of the overall process.
Thank you for that. Somebody else has asked about, they've said, are you seeing enhanced suitability conversations to include values-based conversations? Whoever wants to take that one.
I think that one is probably in relation to sustainability. And I think, if we look at some of our sustainability data from this survey over the years, it probably feels like it's come off the boil, if I could say that a little bit. We talked about that at the last survey where we asked about why sustainability conversations maybe weren't taking place. And there was a bit of the feedback from advisors on that survey was there was a performance issues and there was some cynicism. I think cynicism probably related to performance because like any investment, it's a long-term position. And certainly in terms of the whole bit around cynicism, was it around greenwashing? And I think the SDR labelling will take us much further forward and enable advisors to have good quality conversations with clients about sustainability and values and client values and where they need to invest. So I think it's important, back to what Stu was talking about earlier, that we do really help advisors understand how that sustainability labelling works, but also that they have the tools in place to help support some of these conversations with clients in terms of really probing around the values that clients hold.
I can add something there, actually, Sahar. I mean, when I think about the SDR labelling slide that I showed everybody earlier, yes, the don't know section is just over a third. But actually, in terms of sustainability mixed goals as a label, that's seen a 5% increase. So I think what we're seeing here is evidence of a couple of things. Firstly, multi-asset solutions increasing in popularity for the reasons that Gillian described. But actually, it's amazing how a bit of clarity around the adoption of labels can give advisors as well as clients peace of mind that they are getting genuine products that fit with their values and that they can use them with confidence and with suitability firmly in.
Thank you for that. Philip, did you want to add onto that, or should we move on to the next question?
No, it's an excellent point Stuart's made. Let's move on and get another question.
Sure. I'm actually going to ask one of my own because it looks like we only have time for one more question. I want to ask all three of you, based on today's discussions, what trend do you think will have the greatest impact on the advice industry over the next year? Whoever wants to go first. I mean, Gillian, you can take that one first if you like.
Yeah, that's a really interesting question. I do think, and I don't mean just AI in itself, but I just think increased technology and the delivery of that and the real implementation of that into the advice process has got to start to really take off in terms of leveraging efficiency, reducing cost and risk for the whole advice process. And maybe that will help back to what we talked about in terms of advising next generation. Maybe we can apply some of that in terms of trying to narrow that advice gap, but doing it in a way that maintains efficiency and that advisors are comfortable with.
Sahar, can I jump in? I think with just with my observations, I'm absolutely convinced it's access to private markets. I think that actually, if you think about it, if advisory businesses have got to continue, of course, to demonstrate the very real value that they offer, particularly to their highest top-end clients, then the diversification that comes through that complexity premium of access to private markets, the enhanced returns that is suggested by historical evidence, the enhanced return or risk return profile that's illustrated, I think that's a convergence of needs and requirements that looks very exciting, and I'm absolutely convinced that that will become a more important trend, particularly if it is possible to do so within the multi-asset space, because if the last 2 or 3 years have taught us anything, it's the importance of having a dynamic approach to asset allocation in those multi-asset funds. Is your multi-asset fund fit for purpose? Does it give you access to the kinds of things that we're talking about here? They're key questions. And so I think the long-term asset fund could be a big one.
Well, I agree, but I disagree. I actually think over the next 12 months, the single biggest thing that's going to affect the running of a financial advice business is going to be this confluence of consumer duty, retirement income review, and reviews in general, because I think it will go right to the heart of the kinds of models that businesses are running, how they're ensuring consistency, particularly if they're scaled businesses with a number of different advisors, how you get consistency of processes, how you document advice. And that will really strike quite hard, because there are a lot of businesses that operate in quite an autonomous way within the businesses themselves. And I think the regulator is forcing that much more into a controlled environment. And I think the gas is only going to get turned up, not down, over the next 12 months in those three areas.
Well, thank you very much for that. Well, it looks like
it's a little bit gloomy going into Christmas, Sahar, I'm afraid.
Thank you for that. It looks like we are out of time, unfortunately. So I'm just going to quickly thank you, Gillian, Stuart, and Philip, for a fascinating session. And if your question wasn't answered in the time available, please don't worry, because we are going to send it over to our panelists and they will respond to you personally. Now, before we wrap up, I'm just going to quickly take you over our learning objectives again. So by the end of this session, we said that delegates will be able to, 1, understand the changing advice market and key challenges, 2, explain advisor and client views on the investment market in October and November 2024 and how these have changed and future predictions, and 3, discuss advisor sentiment on key topics such as consumer duty, wealth transfer, outsourcing investment propositions, and the use of technology such as AI. Now, before we sign off for Christmas, let me just tell you about our schedule of events for the first quarter of 2025. I can't believe it's that time of year again. It's come around so quickly. We're straight back into action with our very popular working lunches on the 15th of January with our good friends at Bailey Gifford, where Investment Specialist Director Ben James is going to update you on growth opportunities in the US for 2025. And then the following week, on the 22nd of January, we are going to be hosting another online working lunch, and this time with Orbis Investments, where investment counsellor Rob Perrone will give an insightful presentation entitled Risk and Return from the Bottom Up. Then in February, we're going to be out on the road again, this time with a subtle change to our Q1 multi-asset roadshow. Given the rise in popularity of MPS, we've renamed it the Multi-Asset MPS Roadshow. We're going to start with the roadshow at Alton Hall in Leeds on the 4th of February, followed by Warrington on the 5th, and then Coventry on the 6th. The following week, we're going to be at Lee Court in Bristol on the 12th, and then we're going to be finishing up in London on the 13th. So we'll have a total of 6 presentations for you from BlackRock, Clever Advisor, Morningstar, Momentum, Orbis and Quilter Cheviot, and our keynote speaker will be De Facto's Insight and Consulting Director, Paul Tinkler. So all in all, that's a total of 5 hours of CPD over the next 10 weeks. As ever, if you wish to find information on or to sign up at any one of our events, you can do so by visiting our events page on professionaladvisor.com/events. So that's it for today's session. All that remains is for me to once again thank our wonderful panelists, Gillian, Stuart, and Philip, once more for their insight and answering all of our questions. But as ever, our greatest thanks goes to you, our readers, our audience, for your company, not only this lunchtime, but indeed for attending any one of our professional advisor events this year. I trust that you found the past hour helpful and worthwhile. So for now, I would like to wish you a very happy Christmas, and we very much look forward to seeing you again in the new year. Thank you very much, and good.